Okay, hi, good morning, everyone. Welcome to the Macro Snapshot. We are Friday, February the 6th, 2026. Okay, so let's look at a few charts here. Yesterday we had a bit of a risk off tone. So we saw equities broadly falling across most sectors, not only in the US, but also globally. Um, Now, why was that? There was, I mean, there's a little sort of, okay, so first of all, we have concerns in the technology space, I would say for two reasons. First of all, the capital expenditure, the CapEx, is starting to sort of worry markets that, the return on investment is just not going to be significant enough. And so, for example, yesterday afternoon, we had Amazon, which, like a couple of other, the big sort of hyperscalers, basically reported fairly good results. But in the case of Amazon, for example, they were talking about a $200 billion sort of capex spend for the next year, and that was significantly above sort of estimates. And so the market is starting to go, hey, all of these hyperscalers, these 6 or 7 or 8 or 10 companies are spending a ginormous amount of money, and will it show up in sort of profits and consumer sort of consumption basically. So the market's worried about that. The second issue is this whole idea of AI disruption, which we saw a lot of that. And just looking at this chart here of IGV, which is kind of the tech software, so software as a service kind of companies, and you see that yesterday that continued to tumble pretty dramatically. Although it is oversold and getting to an interesting area. It was interesting yesterday. I thought it was going to sort of perhaps start to stabilize, but it's still got a little bit more bleeding to go. And basically, this idea of disruption is sort of centralized on the fact that sort of companies may not need to outsource their software and can essentially be using sort of other AI platforms like Anthropic or whatnot to look after their internal sort of software needs. And that is basically destroying a lot of companies. Also, companies like sort of private equity companies which have exposure to those. So the point is that there is some kind of concern, so just call it concerns in the certain sectors of the technology industry. But what was interesting yesterday is that we got sell-offs not equal, but sort of more or less across the board. So you've got the XLK there, you've got health, not as bad, but still coming off a little bit. You've got the financials coming down. You've got the discretionary coming down pretty hard. You've got the communication services actually was okay. But then you've got a little bit industrials. What else? You see here the consumer staples, which had been doing super well, are sold off. Even energy had a bit of a flat day. The point being is that correlations yesterday are going up. And why is that important? So correlation between the individual equities. If you remember 2 or 3 days ago on the video, I was showing that it was like massive outperformance, let's say between consumer staples and discretionary. But whereas what we have starting to see yesterday is that a lot of the correlations between equities are getting closer. That means that they generally was starting to sell off. So as the correlations go higher, get towards one, and actually assets in general start to correlate towards one, which we've seen a nasty sell-off, that actually is very bad for things like systematic funds doing, let's say, long-short strategies. So if you have a huge hedge fund which has a long-short strategy, the whole premise of that is that there's going to be sort of different sort of performances. But if they all start sort of underperforming or performing badly or performing negatively, that means that you're losing on both sides. So you're and that's the problem. And so that's why we're starting to see a little bit of liquidation, and I think people going towards some safe havens. So yesterday, for example, if we look at, just want to go back to my main thing here. So if we look at, let's say, for example, the bonds to start off with, you can see that yesterday on the 2 year, we can see that the yields really sort of came down a lot. Everything's sort of come back overnight, but basically we had at the front end, the yields going down a lot. If you look at the 10 year, you see the yields coming down a lot yesterday, and the 30 year coming down a lot. And so it's kind of interesting because you could look at that and say, oh, is that a sort of a safe haven risk off, or is that something to do with the Fed? And if we look at, let's say, something like a September 2026, a sort of a SOFR sort of future here, you can see there was a big sort of push upwards. Now, can you argue that this is pricing in more cuts by the Fed because of, wash or because of the economy? Probably a little bit of everything. But what I would urge everyone to just keep in mind that often in times of stress, where the equity markets are falling and this is falling and, correlations are going to one, often, big sort of institutions will simply, deleverage a little bit, reduce their position sizing, and put some of the money in the short-term money markets. And that, potentially could be some of the SOFR futures. So the point I'm trying to make here is that we can't necessarily assume or extrapolate that a significant move in the front end, which we saw yesterday, I think it's like 10, 11, 12 basis points. We can't necessarily say, oh, therefore, that means the market thinks the Fed's going to cut more. Mechanically, yes, that is the situation. But one could also argue that mechanically, some of these moves is simply a bunch of money being shifted out of riskier assets into a short-term holding pen, which is like the short-term money market instruments, things like the SOFRs, Fed fund futures, T-bills, all that kind of stuff, which mechanically will push up their price and push down the yield. So I want to see what happens. Already we're seeing a little bit of reversal on that. So excuse me. So let's see how that plays out today. What I can say though is that the volatility is definitely pushing higher. And as I was trying to say yesterday, you see that the volatility yesterday we got up to like almost like a 23 handle on the VIX, which is quite elevated. And of course, that's always going to be a problem or a headwind for the equity. So you see, volatility has come down a little bit, but to be honest, it still remains over 20, and that is signaling at least, let's say, hypothetically, theoretically, a 1.5% move intraday. So, still have quite a lot of volatility. And for the equities really just to calm down, we will probably need to see the vol, get down to like, 18, 17, 16, something like that. So let's see how it plays out today. We also see the volatility of volatility itself. So the VVIX, it remains very elevated. So the point is that the volatility itself is moving around. And as I keep on trying to say, volatility is a key input to every single institutional trading book. The volatility, the value at risk, the VAR measurements, all of this kind of stuff. Everyone is deleveraging, and as soon as they deleverage, obviously that generally leads to a bit of a sell-off. So we'll need to see the VVIX go down. We'll need to see the VIX go down. Obviously, in the precious metals, we've seen gold vol come down, but it's still very, very high. And if you look over at silver, that's extremely elevated still. And even in the MOVE index, which of bond volatility, that's been relatively calm, but even there you can see there has been, excuse me, a little more volatility. So overall, the volatility landscape needs to calm down a little bit for the general markets to calm down. Now, if we look at some of the equities, we had a broad sell-off yesterday. Everything's kind of stabilized overnight. And it's interesting just to see what has bounced. We see here on the ES, beautiful fib sort of level here achieved, got down to the 61.8, even back to the 65% sort of fib pocket there. So basically, that's bouncing off there. But again, as I always like to do, the bulls will need to retake that higher over a fib. Sorry, as usual, I've got way too much junk on my laptop. So what do the bulls need to do? So you see here, we got to that fib level, it bounced off. Okay, the bulls now need to chew through all these reverse fib zones. So it's like we kind of failed at the first one here, the 38%, which comes in at about 68.70. So what the bulls will need to do today is to keep on working through the 38, the 50, and the 61% fib retracement. We'll see if they can do that. Let's see what happens today. So far, it's just a reactive bounce. I think I would classify this as a neutral bounce, not necessarily sort of bullish in any shape or form. In order to be bullish on the ES futures, we would have to first of all have a clear break of the 38, the 50, and I would actually suggest sort of up here the 61.8 fib. So we need to get up to 69.50 and higher to really say that this was anything other than a reactive bounce. Similar kind of situation at the Nasdaq. As you guys can see here, weaker than the ES. We actually went through those fib levels, but it did hold at this horizontal resistance, which coincides with the 200 EMA more or less at about 24,300-ish. So a similar kind of situation to the ES. Again, the bulls, if they want to keep this going, they're going to have to get higher. So let me just get rid of some of these here to clean it up. So again, what's going to have to, sorry, that's the wrong one. Let me just redraw that fib. So what you can see here is that we haven't even got to the 38% on the NASDAQ. So definitely the NASDAQ is underperforming the general index. If we look across at the Russell, again, similar kind of situation. That one did hold, at the 61.8% fib in the fib pocket there, more or less the 50-day moving average. So we see the hierarchy already is that the Russell is outperforming the general sort of SP 500 index, and the NASDAQ is underperforming. So there's a clear hierarchy. Let's see what happens this morning at the open. And again, all of these are having reactive bounces, but what's really going to be the tell is to see if they sort of push beyond more than a reactive bounce. Again, looking at some of the sort of the ratios, I'm not going to go into too much detail, but you see here the Mag 7's underperforming. NASDAQ's down about, Amazon is down about 6 or 7% this morning. So, obviously we'll keep an eye on that and see whether there's some kind of reactive bounce or genuine bounce. And that capex overspend is sort of forgotten. So you see here the mags is underperforming. You see the equal weight, doing relatively well, still sold off, but not nearly as much as the Mag 7. So again, we're seeing, momentum is underperforming value. We're seeing small caps outperforming. We're seeing the mags underperforming. So all of these sort of relationships are still sort of holding. If we look at global equity, again, I'm not going to go into a huge amount of detail, but basically, global equity sold off yesterday, again, mostly having a bit of a bounce. There was nothing which particularly was wonderful, but overall, the US was a little bit weaker. What I will look at now is just a couple of other markets. So if we go into the oil here, oil you can see is it failed here at this fib. So we had a nice bounce, but basically failing around about the 64.40, which is the 61.8 fib retrace there. And why is that? There's some sort of informal talks happening in Oman, I believe, between the Iranians and the Americans. They kind of withdrew, they came back. The Americans withdrew, they came back. So the market is still on edge, and you can see that's being reflected in the price action here. That the market is essentially saying, okay, from a geopolitical point of view, the market is from a fundamental point of view, the market seems to be a little bit oversupplied. We even had the head of Shell Oil yesterday saying that he said, oh, I think, the market's a little oversupplied at the moment. So the fundamentals are a little heavyish. We saw that the official selling price for Dubai crude and the Saudis yesterday into Asia was actually reduced. So that indicates sort of a slight sort of softness in the market. So the fundamentals, I would say, are a touch on the soft side. So therefore, looking at, let's say, the geopolitics of it, the market is saying, okay, the Iranians and the Americans are talking, but it's just informal talks, but at least they're not sort of, hitting at each other. So we're going into the weekend. The market doesn't really want to sell off on the fundamentals, but it doesn't really have the energy to rip higher. That's probably going to be a situation which will be determined today by any headlines coming out of Oman at those talks, something positive, something negative. Let's see what happens there. In terms of pretty interesting in the currencies, quite a lot of stuff going on. If we look at a few of the currencies here, we can see the broad dollar index, which again is about 58% euro, so it's almost like a euro index. You see here that it had been strengthening, but it's sort of failed. Well, I don't want to over read into this, but again, let's just say that it's paused at this sort of key level here, which there's horizontal overhead resistance at around about the 98 level, which also coincides with the 61.8 fib retracement. So this is a pretty key level here because the bulls need to push this higher. Otherwise, we could see just a little bit of softening, a bit of sort of sideways consolidation, or even a drift lower. And again, the fact that we had, perhaps a slightly soft data yesterday. We had the JOLTS number, which was pretty flat. We had initial jobless claims and continuing claims going up a little bit. We also had the challenger job cuts yesterday, which seemed to be a little bit sort of negative. So yesterday there was a little bit of negativity, a little bit of perceived softness in the job market, although I would argue some of those readings were during snowstorms, and I don't want to read too much into it, but the market did take that yesterday as being a little bit soft. And potentially that's not helping the bull case for the dollar. So let's keep an eye on the data. We have next week, in theory, we're going to have the non-farm payrolls, I think, on Wednesday being released. So let's keep an eye on the data. But that soft US data yesterday and survey data didn't help the dollar here. What we're seeing over in the euro, again, is again, I don't want to read too much into it. It's just kind of consolidating here. It's maybe going to hold this fibs retracement zone. Yesterday we had the ECB. There was no sort of rate hike or cut, obviously. And when questioned about the strength of the euro, Lagarde was relatively sanguine about that. And I think she was able to be relatively sanguine and relatively relaxed just because the euro strength has come in a little bit over the last 6 or 7 or 8 trading days. So, there was no particular boost given to the euro there. What we are seeing is continuing, the Swiss franc, especially against the cross pairs, maybe not so much against the US dollar, but the Swiss franc, if you look at the cross pairs, is doing pretty well. The pound was an interesting one, because the pound yesterday had a bit of a nasty sell-off. It's recovered a little bit. And that's just because the Bank of England decision yesterday, there was a 5-4 vote in favor of a hold. So that means that 4 people actually voted in favor of a cut. That was expected to be 1 or 2 people only voting for a cut, but we did get 4 members of the Monetary Policy Committee voting for a cut. So quite a dovish sort of overtone to that meeting yesterday. And the market started to price in another cut maybe in March or the following meeting. So that's a negative for the British pound. But really what's also kind of interesting, and I'm not going to show the chart, but we saw the 2-year yields coming down. So the market was saying, okay, great, the BOE might be a bit more dovish. So the 2-year yields in the UK came down. But what's interesting is at the end of the day, the 10 and the 30-year yield actually went up a little bit. So we had kind of like a steepening there. And that's essentially saying that the BOE may be cutting, but inflation is still not licked. And probably also that's reflecting some of the internal political drama. Prime Minister Starmer, there's a bunch of sort of rumors going around that, the sort of the members of the cabinet and the broader sort of, Labour Party members in the House of Commons are not super happy with his leadership, and there could be a leadership challenge. And the logic there is that if Prime Minister Starmer goes, there's going to be less stability, maybe a new prime minister who potentially might want to juice, the economy by spending more. And we're getting back to that old bugbear, the bogeyman of fiscal irresponsibility. So all that to say, that explained why the long end yields went up, and we had a bit of a sort of a bear steepener yesterday in the UK, despite the fact that the BOE was dovish. And just keep in mind that the bonds yesterday in the US and globally at 7:15, when we did get that, around about 7 o'clock yesterday, when we did get the BOE decision, that caused the yields to fall globally. So interesting. So the point being that if you're trading the British pound, you need to be understanding the internal politics there, and the fact that the BOE seems to be slightly dovish, which is a pound negative, but we're also potentially getting some internal political instability, which is actually not that great for the pound as well, although the fact that it is bouncing a little bit this morning. When we go across to the Japanese yen, so we've got the USD JPY here, you can see the dollar's had a nice run, pushing up towards so-called potential sort of intervention territory. But the reality is, remember this whole thing about the rate check of the New York Fed and potentially the Bank of Japan and the Ministry of Finance in Japan intervening, checking with markets, rate check, blah, 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 intervention potentially. The reality is, what we've seen over the last 2 or 3 years, that any intervention, verbal or real, has only really lasted for 2 or 3 days. And we see the US dollar continues to gain strength against the Japanese yen. So the fundamental macro situation in Japan of a huge debt load, of potentially a prime minister who wants to spend more and stimulate the economy, cut sales tax on food, all of these kind of dynamics. The pressure valve is going to be the currency of that country, and that's why we continue to see the Japanese yen. It just cannot sort of strengthen really. Even it goes down for 2 or 3 days on intervention, and it continues to weaken, as we're seeing here. The US dollar is strengthening. Now, keep in mind, of course. Some of this could be front running the weekend, because the weekend we have the snap election. Takaichi, the prime minister, she's expected to improve her majority. And again, the market is saying, hey, if she's going to have more of a majority, maybe less control, more fiscal spending, is this going to lead to the BOJ hiking? We don't know. But the market at this point is basically pricing in like a super majority, an extra majority for the Liberal Democrat Party. And therefore, that will leave Prime Minister Takaichi with the possibility, allow her to have more sort of ease in instituting stimulative policies, which is not great for fiscal trade balance. So that's what's happening in Japan. Keep in mind, in Canada, we had interesting comments yesterday by the Bank of Canada Governor Macklem, who essentially was pretty downbeat in terms of the Canadian economy, and saying that because of the structural sort of realignment, the structural sort of rejigging of the Canadian economy, tariffs, Trump, Prime Minister Carney, there could be soft growth for the next 2, 3, 4 years. He was pretty pessimistic about the Canadian economy, and he said that there was no point cutting if that was just a real economy issue. So quite sort of negative there. US dollar has been strengthening against the Canadian economy, the Canadian dollar. Given back a little bit this morning, like everywhere else. What we do have this morning in Canada is employment numbers. So let's see if that is going to sort of, maybe negate some of Tiff Macklem's negativity, show what's going on with the Canadian economy a little bit, the employment situation. We have that this morning. That's going to be an interesting one. The Aussie dollar continues to do quite well. Obviously, it's sold off a little bit, but quite a strong comeback this morning at this key level, and that's almost looking quite bullish, like a bull flag here. So those of you who like the commodity story, the fact that Australia is relatively isolated from some of the global geopolitics, and internally the Australian economy seems to be doing quite well, strong employment situation, a relatively hawkish Reserve Bank. We saw the RBA hiked a couple of days ago. So that could be an interesting entry point here for the Aussie dollar. That's an interesting one. Just to finish off, what I do want to talk about a little bit, I want to talk just a little about Bitcoin, because it's interesting sort of thoughts. Just by the way, just while we're down here, I just want to show just a little bit on copper. We saw the precious metals. Hold on, let's have a look at gold. So we see selling off, coming back. I think this is just still stabilizing. Volatility is very high. I'm not going to go too much into it. I could do, but I'm not. I just think here we need a few days of stabilization before we can say too much about that. What I will just have a quick look at is copper. Now we have the Chinese Lunar New Year coming up, relatively soon. And if we have a look over at copper here, you see the copper's selling off a little bit like the precious metals. It's just trying to sort of consolidate here around these fib zones, trying to push higher. But what I would say is that copper, if you look at the inventories and some of the global warehousing for the main sort of futures contracts, you can see here that overall the inventory, so that's the stock of physical copper, is going higher. So you can see here the LME in London, you can see here in Shanghai the big, the big copper market, and also obviously in COMEX in London. So you see the three of them overall, the exchange monitored warehouse stocks. You see here that that's pushing much higher. So that would indicate a relatively soft physical demand at copper just at the moment, sort of on the microstructure. So maybe that's one reason that copper is kind of under a little bit of pressure. Just want to have a quick look at the Bitcoin chart, guys, because obviously the crypto is going down and BTC. So just from a purely technical perspective here, let's just sort of look at this a little bit. Now, we know that it broke the key levels, which we were seeing at about 75,000. But we are getting into points now. We have a pretty strong support around about 52,000. If we just scroll backwards here, you can see here, obviously, this is a key level down at about 52,000. And if we look at something, but even you could say 52 to 60,000, there's quite a lot of sort of volume was printed down there in the past. And you can also see that if we look here, this bear flag and the Fibonacci extension here, we're starting to reach some of these Fibonacci extension targets. We had the 0.786 at about 62,000. That's reached. So what I'm trying to say, a little bit of stabilization here would not be crazy. But what is interesting, just a couple of thoughts here. If you look at the flows of the ETFs and whatnot, I've just got a couple of charts which got my attention just to see where market participants may be. And what this chart shows, which is kind of interesting, is basically it puts together all of the BTC ETFs. So all of the ETFs, the large ones and the small ones. And then essentially you got the price here of BTF, on in sort of golden sort of yellow thing here. And obviously you see it's come down. But what's interesting here in the blue is the average cost of all spot BTC ETF inflows. So this is essentially calculating since day one of all the ETFs, the average price. So it's sort of an approximation of what might be the average, sort of P&L or situation of ETF holders. And you can see the average price is calculated yesterday, the 5th of February, 26, is about 90,000. So that would indicate that on average, and again, this is only on average, people involved in ETFs technically are underwater. And you say by how much? It's come down about 41%. And so you're talking, about a $16 billion sort of drawdown, because what we've got here is the gain in the loss and all of that kind of stuff. So the point is that one could argue that it's just interesting to think that, potentially the average sort of, at least in the ETF space, the holders are sort of underwater down from 90,000 to where we are currently about, 64, 65,000 or so. So that's an interesting one to look at here. And then another interesting thing to look at here is that, and again, I just want to pull back a little bit, because BTC, if you look at it not so much as a store of value and a sort of anti-fiat and all that kind of stuff, if you say, hey, this is a technology, like a software technology, which essentially runs on a blockchain and whatnot, it's just interesting to look at if you consider it from that perspective. I'm not saying that's my personal view, but if one did consider Bitcoin to be nothing other than programmable money, a kind of sort of software, it's just interesting to look here at the IGV, which I've been looking at the software ETF, and you can see here that's highly, highly correlated to Bitcoin. So you see here Bitcoin here in sort of the gold and yellow, and if you look here at the software ETF, the IGV, you can see how highly correlated they are. So that's an interesting perspective. And another thing which I just want to talk about for a second on BTC, and again, this is just bear with me for 30 seconds here, is if you look at BTC, one of the original ideas it was to sort of say, hey, it's got a hard cap of 21 million. So it was very much a sort of a capped supply story, supply and demand. Okay, it's like, oh, Bitcoin. But what's interesting, if we look at the financialization of Bitcoin, which has happened massively over the last year or two or three, and what do I mean by financialization? That means that suddenly we have Bitcoin is not just the Bitcoin, but all of the derivatives which now surround that. So it's no longer purely a supply and demand story. We have synthetic supply. Now remember, what is synthetic supply? You have like a synthetic float, synthetic supply. You have technically claims now, derivative claims on BTC. So you have things like you have options, you have derivatives, swaps, you have futures, right? So the point I'm trying to make here, guys, you have ETFs. So all of this universe of ETFs, swaps, options, IBIT, futures, all of this stuff is not Bitcoin. It's the financialization of that instrument, of that thing. It's like no longer gold or oil. You have this giant derivative market, which infinitely the supply is theoretically infinite. Hear what I'm saying? It's not 21 million Bitcoin. That is one thing. That's like saying, oh, the amount of gold which is mined, the amount of oil which is pumped. But remember, what drives the oil market? The oil market originally and the gold market were for speculators, gold miners, oil producers back in the 60s, 70s, 80s. Real producers. Sorry, did I say it was speculators? Real producers is only 8, 9, 10% of those markets. 90, 95% is financial speculation, the derivatives market, futures, ETFs, options. My point is, do we need to sit back and look at BTC and say, hey, BTC is no longer what it was. This is no longer a finite supply of 21 million Bitcoins, because now you have an infinite, unlimited theoretical supply of derivatives. Anyone can go and buy a call, an IBIT. You can buy futures on BTC. You can buy options on futures on BTC. It's infinite. So my point here, and I'll leave you this point here, is this no longer a supply and demand kind of price discovery mechanism? Because if you look at the other financialized markets, basically, how does supply and demand is part of it. We're just talking about oil. Okay, the fundamentals. But we also have a huge amount which is determined, the price discovery is determined by positioning, hedging, liquidation flows, financial actors, institutions who are selling on rallies, forcing liquidations, buying on dips. My point is, guys, I think it's very important that everyone involved in the BTC space and maybe even the broader crypto space understands that this, in my humble opinion, has changed radically since the last few years, because we now have derivatives and essentially a financialized product, not just a supply and demand product. Remember, oil, gold, they have physical stuff, but the markets, the price moves 89% on positioning, liquidation flows, hedging, options, derivatives. So I'll leave you with that one to think about over the weekend. So I think it's just as important when we look at the BTC chart, not to get caught up in old historical narratives like, oh, there's only 21 million of these. No, there's an infinite variety, supply in terms of the derivative market. So suddenly you're getting into all kinds of different flows and dynamics from, let's say, I don't know, maybe 4 or 5 years ago. Something to think about over the weekend. Talking of which, have a wonderful day. Have a great weekend. We'll be back on Sunday. Actually, we'll be back on Sunday. We'll do the big sort of macro overview from the macro shop here. Okay, thanks very much, guys. Have a great day. Take care.